Is it time to rethink the classic 60-40 portfolio? Well, as public markets have become more indexed and correlated, Apollo Global Management says investors should look to diversify into private markets. Joining us now is Stephanie Drescher, partner at Apollo Global Management, joining us here on set. It's great to have you. Welcome.
Thank you so much for having me.
We've been having this conversation about greater access to retail investors, individual investors of the private markets. Apollo has certainly been spearheading this effort. So that's exactly where I want to start. Why does the traditional 60-40 portfolio not necessarily make sense, especially at a time where it does seem to be working again, albeit perhaps just here in the near term?
Look, the 60-40 portfolio has, if we look at the kind of equity markets by way of example, we recognize that over time, the number of public companies has actually been reduced by half. Yet when we step back and we look at the total number of companies globally, 90% are in fact private. And the reality is that the private markets, whether that's equity or credit, have provided excess return for investors over time. So the 60-40 portfolio, as we think about advisors and clients planning for retirement and building wealth, is missing out if they don't have the private market exposure that ultimately allows them, especially given markets today, to increase their diversification, reduce their volatility, and ultimately achieve the benefits of that excess return.
And I do get that historically private markets tend to be a higher return than what you get in the public markets. But it comes at the cost of liquidity, does it not?
Liquidity absolutely is part of the analysis. When you look, though, through to the client's portfolio, there is a great deal of investors, individuals out there that absolutely can take a portion of illiquidity in their portfolio. In fact, we often say, like, let's look at how much liquidity they need on a daily basis. And the vast majority of conversations we have direct us to a portion of the public fixed income and public equity portfolios having a replacement and rotation into the private markets. So if we look at the structures that are created for the individual today, it reflects a greater amount of liquidity. Certainly in the traditional kind of historic old way of looking at private investments, they were historically very long dated. Now we have a whole suite of solutions that provide incremental liquidity and allow the excess return to be delivered to the portfolio.
Here's my concern about private markets. With the big reduction that you mentioned in the number of public companies over the last couple decades and the imbalance in the strength of mega caps versus other public companies in general. And then you've got some of these super startups like OpenAI, Stripe, Databricks. Might there be a lot of private assets that are also inflated versus what they were historically, so they won't deliver the returns that they traditionally have, but we just won't know for a while?
You know, when you look at the investment rigor and discipline in certainly in our approach to private markets, there is such a strong underwriting case that comes to this type of investing. And so we have great confidence that when we are applying our 30 plus years of investment rigor and diligence, that we're getting to a purchase price that we're extremely comfortable with in terms of entry, and then great transparency as it relates to the valuations over time.
So with that in mind, then, when we are talking about the private markets and we're talking about alternative assets, are we talking about private credit, private equity? What sectors are looking compelling right now? We've been having a lot of conversations here on Overtime about things like infrastructure, for example.
Mm-hmm. So, look, there's a whole range of opportunities, which is what's so exciting today in terms of alternatives, private markets. Because at the end of the day, for us, the definition of alternatives is simply an alternative to a publicly traded bond or stock. So that could be everything from private IG all the way through to your traditional private equity holding. So within kind of the credit markets, if someone is looking to replace a portion of their fixed income portfolio, they could look to the corporate lending market, asset-backed, In equity, we can replace a portion of the S&P with diversified private market exposure. And then to your point, in real assets, we could look to infrastructure and other climate, real asset-oriented opportunities. So it's really across the risk return and asset spectrum. And what's great is that now there's so much innovation in this part of the market to deliver private exposure to the individual that we're creating tailored solutions that build off of what institutions have benefited from for decades. And when we look at the average allocation of private investments in an institutional portfolio, it's about 25%. In contrast, the individual is 1% to 3%. So there's a huge opportunity ahead to provide that type of opportunity for individuals to build their wealth and save for retirement.